Good morning, it's Jeffrey Cohen. Today is May 6th. I am the investment advisor representative and president of Chicago Quantum, U.S. Advanced Computing Infrastructures, Inc. We are a U.S. corporation. We are FINRA and SEC certified here in Illinois. And we are non-discretionary, so we do not take your money. We give you advice. We charge you for it. So, of course, all the videos are free, and the blogs and the websites and all that, so that you might buy a run. So let's talk a little bit. You know what, before we talk, so if you like the videos, we don't get paid to make them, but it feels good if you let me know you like them. Put a comment in the chat below. Ask a question. Hey, I want you to look at a stock, or what about this, or what about that, right? And then also there's a red button. It says subscribe. If you could please hit the subscribe button, that really helps us too. So today our quantitative model picked 6 stocks for what is actually a very small edge. So Dillard's, MXL, Max Linear, NVIDIA, Silvergate, Block, and Trade Desk. So these are all growth stocks. They're all high risk, high return, except for Dillard's, which is kind of weird to have a retailer in there, but they're doing something. And the model reached equilibrium last night, a hard equilibrium. So either there's better portfolios out there, but we just can't find them, or this is the best portfolio out there. What's interesting is that within rounding error of 10 to the negative 4 of our model, you can also pick 26 stocks. So I want you to think about that for a minute. So the model is set that it's 0 and negative is better than positive. So Spider, SPY, S&P 500. So funny, after a while, I'd figure you as our listeners would know this, but I figure why not just explain it real quick. The CQNS score is set to 0 for all assets, all money-making stocks, and then we run the down run, all money-losing stocks. So 0 is the average. Okay, there's not that many 0 scores. There's, let's count them. So there's 29 0 scores, right? And there's 2 better. So there's only 2 individual stocks that are better than the overall stock market in terms of risk. Normally there's like 25 or 50 of them. So this is not a stock picker's market. Every stock's getting beaten up. Beta is not working. Expected results are not working, and returns are not working. So this is not a time to be playing the beta game, right? Not for a big edge, right? Very tiny edge, 1 times 10 to the negative 4th. But you still have Lattice Semiconductors, still have NVIDIA. Why? They have high betas, so even though this market is tumultuous at best, these stocks are keeping up. It's interesting. Now, let's be honest. One is down 20%, one is down 18%. NVIDIA down 18% is like a super discount. Pays a tiny dividend. Lattice does not pay a dividend, and the volumes are up. So 93% higher volume than all of the average last year, and then NVIDIA is 145% of volume over last year. So these 2 stocks are still in play, right? That's interesting. So Max Linear also is very high beta, very high expected return, but this one's got a ton of volume, 980%, right? Still down 17% over last year, doesn't pay a dividend. So Max Linear is in play. So if you like that kind of thing, if it's Friday and you want to go to the casino, not bad. Amphenol, different. Very small expected return. Stock price is not really down. It's down 5%, pays a small dividend. That's not shabby. And then you got the Carlyle Group. By the way, Carlyle Group, I know I keep talking about you because your stock is rating so high, but we do not have any relationship with Carlyle Group. That, expected return 8.11 when the market return is 4, so not bad. middle of the pack, not a super high beta. Volume is up 11%. Stock is down 20% over last year. And pays a nice dividend, 2%. So you paid while you wait. More than I get in my Goldman Sachs account, Marcus. And then we start to see how the exchanges are doing. So the Spider is the 5th best stock. So it says 4 because in Python, 0 is really the first. So the S&P 500 is really the best place to be putting your money right now, except for the QQQ. So this is very interesting because the QQQ is down. It is a dog right now. It's falling like crazy. But from a risk perspective, it's actually kind of hit that flat part of the curve. If we were to look at a chart of QQQ, I bet you it would be at the precipice of a fall or a rise, but not falling or rising. It's down 13% over the average last year. It's not great, right? It pays a little dividend, 0.5 point dividend. Volume is super high, 275% of last year. So this ETF is trading. It's trading, and the S&P 500 ETF is trading. So if you're in the markets, you're thinking to yourself, people are making bets on the ETF. They're trading the indices. They're not trading the stocks. A couple stocks, sure, but my guess is if we were to look at the average volume, today's average volume versus last year, well, actually the average is 128%. So volume is up yesterday. Yesterday when the market crashed, it crashed on higher than average volume. So that's kind of insight number one. Volume is up 28% across the board. On a very down day. That's a confirmation, guys. That's not helpful if you're a bull in this market. Let's look at the down stocks. These are the dogs. These are the money losers. So you see, I'm just getting right to it. I'm not jumping through a bunch of hoops for you. Because you want to know, how do I get the money, right? You don't want this bullshit. So Lightwave Logic is your worst stock by far. So you look at the stock, and every day people are making money betting it's going to go up, betting it's going to go down, up, down, up, down. It moves like a yo-yo that ends up every day in the same spot, right around $12. It used to be like $8. It moves, but it's not moving much. Expected return is 10%. Does not pay a dividend. It's up 56%. Oh yeah. Which is kind of crazy actually for a crap stock. And the average volume is 21% higher. But let's take a look at this. A couple things. One thing's to bring out. There's a stock in play this morning. It doesn't even show up in our model in the top plays. BBIO. Vinny's. No, BBIG. Vincent's, not even, oh, it's too small. It's a small crap dog shit. Hang on a second. Let's go find it. It's in play. I want you to see it. Today's the day. Vinco Ventures. It was trading. It traded 21 million shares last night. This thing is in play, up 81 cents, okay? This is a meme stock. This is a manipulated dog shit stock, Vinco Ventures. Be super careful if you buy and sell this stock. This is a meme. We did due diligence on it. Maybe it's worth a quarter. Please don't buy this stock unless you are in the game of swinging and playing and betting like in a casino. If you're not a casino gambler, don't be in that stock. Just don't. Just do me a favor. Stay home today. Don't do it, right? So let's take a look at volume on the down stocks. These are money losers, right? Because, we separate out. Money makers do better than money losers. Oh, wow. Money losing stocks on average traded 33% higher than last year. So, profitable companies, stocks, volume is up 28%. So, unprofitable stocks, %33 versus last year on a very down day. So, don't believe the hype. There's volume out there. There's volume on every share, including the main ETFs we follow. That's interesting. The second thing I wanted to share with you. So the first thing I shared was that you could pick 6 stocks and get an edge. You can also pick 26 stocks, get the same exact edge. It's not bad. The second is the S&P 500 variance continues. It's relentless upward climb. 1.14 times 10 to the negative 4. Okay. Our market return, our expected market return for next year, inclusive of dividends, is 4%. So everyone talks about, oh, the market's at a bottom, the market's this, the market's that. So our model says that next year, when you look at the S&P 500, by the way, what's the S&P 500 trading at right now? You know, I'm getting agita from having this conversation. It is emotionally very painful. Talking about the market when the market's not doing well, for me, is emotionally painful. Like, it hurts. I got agitation. So we're at 41.48. The model says that in a year, we're going to be at 41.48 times 1.027 equals this number, plus you're going to get a dividend that's what you're going to have by next year. So I guess if I got to call that, by the way, my wife's texting me, that's nice. So while I've been talking, the futures have swung positive. This is a crazy market. I'm not going to pretend to understand it at the macro level. But 41.48 times is 42.59. Let's call it 42.60. So a year from now, the S&P 500 will be 42.60, and it'll still pay the 3.2% dividend. That's our call. So if you like that call, you'll like our model. If you think that the market's going to drop, it's a whole different thing. Look at the futures. They turned positive. You know, I put my daughter on the bus for school today. The futures were negative. They were negative all night. Everyone's, crying. Futures are negative. Now, this morning, they're up. I understand that the futures are sending a message. I believe that the message they're sending is, hey, I want to be heard. Listen to my message, right? The VIX is going to be another thing that we talk about. So the other thing that's important to know is the CQNS power of our run. So we have a very small edge. We have a very small kind of confirmation, right? So what this says is a small number on CQNS power means that minimizing risk is much more important than maximizing expected return. Our model is telling you that expected returns are not high enough to be taking those outside risks today. So that's the other thing. Risk mitigation is more important than return maximization today for buy and hold investors, right? Protect yourself. Focus on stocks that reduce risk when held together. So what's interesting is that these 6 stocks are risky as hell. They're crazy. They're crazy stocks. It's a very risky portfolio. But through math, it has the lowest historical closing price variance over the past year. So, not bad. You're buying less risk. This is the same thing, except I would argue that this is not very risky. Because with 26 stocks, it's less risky with 26 stocks, but this is what's important, but it's expected to return exactly the same return today. And with exactly the same risk. So maybe the answer is this is also still a very risky portfolio. It just has 26 stocks, right? That's interesting. So we talked about market return. S&P 500 is up less than it's 0.84 excluding dividends. With dividends, it's 2%. So you made 2% on the S&P. The IWM is down 16%. So with dividend, you're still down 15%. Yeah, I live that. I live that dream right there. QQQ pays about 1%. So minus 442, reality is with dividend, you're down probably 3.4. So you lost money this year. Everyone lost money. And here's the other thing that's important, which is not in our model. Not only did you lose money, everyone's pretty much, every buy and hold investor is losing money this year on individual stocks they bought. Maybe not every single person, right? So if you go to FinViz, 21.4% of stocks are above the simple moving average 200 days. 21.0% of stocks are above the simple moving average 50 days. So why is that important? Because if you bought the stock 50 days ago, you're down, right? The other thing that I see here, which I think is important, is that there's 93 new highs. There's 1,142 new lows. And yesterday, so just to see if you felt good, 10.1% of stocks went up. 86.3% went down, which means (3.7%) unchanged. You had a bad day yesterday. You did, unless you're short. But we don't play that game. We don't play that short game. We're always long. We love America. We love the stocks. We love companies. Let's talk about it. So our down portfolio has a 2.87 power. Our up portfolio 296. So they're both not really having you bet on the returns. The expected return, though, if you invest in money-losing stocks, is 6.3%. The expected return, if you invest in money-making stocks, is under 5. So why do you invest in money losers, right? Because if they turn around, they go up. Money-making stocks, it's easy to invest in them. You make less money, but there's a lot more confidence. By the way, there's a lot less variance, too. You see that 1379, 3528. That's like 2.5 times the variance. Quick math check on that one, right? 3528 divided by 1379, it's 2.56. 2.56 times the variance for investing in money-losing companies. Think select quote. But your return, 629 divided by 494, it's a 1.27 times extra expected return. So you're taking 2-to-1 risk return. So I don't know if you like that. I don't like it. So our down run pick is basically to avoid or short Lightwave Logic. Stay away from it. Then there's ZY. So if you want to work together, you see how the CQNS score falls by 2/3 when you add a second stock to your short play. So what it's really saying is if you were to look at LWLG, just look at that stock. That stock has an extraordinarily high risk for the return you get. Avoid it or play it. But don't sit on it. Look at that volatility. Was that 11% for the week, 10% for the month? This thing is so volatile that in any given day, you can bet on it. They're calling it a head and shoulders. It doesn't matter. It is the worst stock from a risk-return profile, LWLG. Do you want to play it or not? Right? Choice is yours. But our model says this is crap. You want to keep away from it. I'm just telling you what the model says. It's not what I say. There's people making money. There's people working at Lightwave right now, trying to come up with ways to do transduction. By the way, I love transduction. They're trying to use like polymers to convert light waves to different light waves. We were thinking of doing it with quantum light waves, with entangled light waves, right? Wow. So now I want to share with you where we were yesterday. So yesterday, before the market crashed, the model picked 10 stocks to 25 stocks for that same edge. And by the way, we don't update the efficient run in our Yahoo Finance every minute, every day, but roughly the same stocks. Those 10 stocks, when the market fell yesterday, went horrendously wrong. So if you were in the Chicago Quantum Net Score up run, which was best return, lowest risk, high beta, you lost your shirt. I'm so sorry if you were there because, wow, did you lose money. So if we look at those, where were you yesterday? You know, Silvergate, you probably want to see the name of the company. It probably makes it easier for you. Yeah, you just have to trust me on it. These stocks... Whoa, easy now. It's not what I was expecting. How are we doing on the... Oh, the Russell 2000 is down. Futures. I just think there's a lot of huffing and puffing in the futures right now in the pre-market. I don't buy it. I'm not buying it. Wow, the... server is super slow right now. All right. First off, if you were in these stocks yesterday, you lost money on all but Zim. Okay? Sorry that you did that. Our efficient stock picks from, this is like a week ago, are high market cap, ranging from 469 billion down to 753 million. But it looks like the median score there is about 3-4 billion. They dropped. They actually dropped on a lot of volume, high volume. So this was a volume confirmed drop of your efficient stock portfolios. So what that tells me is money managers, smart people, institutional investors who are investing in what I call smart volatility ran for the exits. So I was reading last night, people were asking the question, did a fund liquidate? I don't know. I don't know, right? There's a lot of funds out there. Maybe one of them did. I don't know. But this tells me that if the risk manager came over to the trading desk and said, hey, guys, you got to get rid of some stuff, they probably sold the smart volatility play because they figured everyone's in the smart volatility play. It's easy money because it's low risk, high return. Dump it. And so that dropped a lot. And so the good news is it's going to go up if the market goes up. This is the smart money. And now the smart money has between 6 and 25 stocks in it. So you don't have to be one of those people that invests in 5 stocks and calls it a day. You could actually invest in 25 stocks at a time and have just as much edge. That's what I would do. If I had to be long in this market, if I had investor money, I would drop it in 26 stocks. You think the market's going to go up today? You feeling good about it? I don't know. I can't predict the market, but yeah, futures are up, right? And by the way, I bet you if I go over to FinViz and I look at the futures, I bet you're going to see the whole game. All right, let's take a look. You know what? It's so stupid. I have a feeling this whole thing is manipulated today. I don't feel good today about the market. By the way, FinViz is behind. I don't understand why that would be. Why their indices are still negative and Yahoo Finance was showing positive. It tells me I probably should just go to my broker. No, they're negative. Okay. So all the futures are negative. Great. We're gonna have a crappy day, right? Down to 0.5 point. But let's take a look. The VIX is down slightly. VIX is really high over 30, right? So that means that's bad for the market. Let's have the same talk we did, a couple days ago. The US dollar is down, which is good for the market. But the VIX, I say VIX is neutral. Dollar down is bullish. Copper down is bearish. Silver's unchanged. So there's no play there. Oil's up. Gas is up. Natural gas is down slightly. And then you got your yields. Your yields are up. Your bonds are down. So we got to check that. Let's talk about that. So what I just saw was a bunch of mixed bag, right? Oh, that was the one I wanted. Market activity. Yesterday. Total issues traded. Decliners well ahead of advancers. Decliners, now not a lot of high yield traded, but a lot of investment grade traded. Treasury traded flat. Corporates traded down. So where are you going to put your money? You can't put it in fixed income. Oh, I want to scream. If you're a fixed income fund, you're losing money. There's nowhere to run. There's nowhere to run. The 60-40 portfolio. There's nowhere to run. You're losing money in bonds. You're losing money in stocks. You're probably losing money in commodities. Unless you're bullish oil. How can you be bullish oil at $109 a barrel? You have to have guts. Guts, like real guts, right? So bonds are falling, both government and investment grade. The dollar's way up. Way up. VIX is way up. Where do you run? Where do you run to? Where do you hide? Oh, and inflation's like 7.5%. You can't even put the money in the bank and think you're going to make money. You're losing 7 points in the bank. You might get 1% interest. So you're losing 6 points in the bank. This is what every money manager's coming to work feeling today. They got a gun to their head. They don't know where to go. And now the exchange, the indices are down. So let's talk about where you might put your money. Jeff, where can I find an edge today? Well, let's look at money managers. They're down. By the way, Cohen and Company, they have exposure, real exposure to SPACs, which are down like 90%, and they have to mark to market. Cohen and Company is going to have accounting losses for a long time, and I'm very afraid of what's going to happen. Ben Franklin Resources. By the way, I love the management team. Jenny, if you're out there listening, you're awesome. Should have taken that job with you about 20 years ago. I love you guys. Wish I was working for you as an advisor. Down 6.5, 6.6%. This is a good stock with a good dividend, a lot of exposure to fixed income, a lot of exposure to international. It's a tough play, right? Blackstone, down 6%. Janus, down 6%. Invesco, down 5.5%. T. Rowe Price, I don't know you guys, down 5.5%. Carlyle Group, down 5.3%. BlackRock, down 5%. Ameriprise is down 4.5%. B. Riley, pretty risky, down 4%. If you're making a list of where to put your money, money managers isn't bad. But if you put your money in money managers and the market goes down again today, it's going to be an outsized loss. Because there's a reinforcing cycle of doom on the money managers, right? Assets under management pay money managers. Money managers make money when the market goes up. Market's going down, money managers go down. I can't IPO. I'm not doing a lot of mergers. I'm not managing money. If I've got a hedge fund, either I'm the smartest guy in the world or gal in the world, or I'm the dumbest, right? I'm making or losing money. I don't know what's going on. I don't like this kind of volatility. All right, shitcos. Now, I'm sorry I use that name, but they really are. A lot of them fell a lot, right? We avoid these. And if anything, we had a list of companies to short. They're all down. I don't have the guts to short them. I got to tell you, I'm scared to short in this market. Just like I'm scared to be long in this market. I have $6 in my investment account. And just in the spirit of full disclosure, me personally, I have 14% of my net worth in equities right now. Long. 14%. Do you know about 2 years ago I sold? About 8 months ago I sold? Sure, I missed the last little upswing, but I'm not worried. I'm going to have plenty of coffee for the rest of my life, right? Because I'm sitting at 14% equities. I don't think the downturn has even started, right? I do have investments in 3 stocks, though, and I can share them at the end. I'm not a pumper, right? So I'm not going to do that. You could invest in cannabis. I do believe that cannabis is the future. I believe they're going to legalize cannabis and everyone's going to get high. It's going to be in soft drink containers. You're going to go to a bar and you're going to buy a beer and it's going to be infused with THC. I believe people are going to be growing. I believe medically they're going to find cures for cancer and obesity and all these great things with cannabis. But for right now, if you were in cannabis, you are the saddest person I know. There's traders out there that are in cannabis. Look at MSOS at 14. This is an ETF that tries to hold exposure to the cannabis. It's a small one. I like them. I think they're doing a hell of a job. They're very transparent. But let's take a look at this ETF over the past 2 years. You're crying. By the way, is anyone writing all this stuff down? I got to put all this out in a blog or something, right? Look at this. This is the most horrible story of the stock market I could imagine, right? This is terrible. I'm disgusted when I look at this. The Cannabis Etf launched in 2020 at about 20 bucks a share, 22 bucks a share. Fine, it made it to about 48 at the high, the close, right? It's been down ever since. It's at 14. And honestly, it's probably got a lot more room to fall. Look at that volume confirmation on the falls. But I like them. It's the gold rush. Okay, crypto and mining stocks. So I like the mining stocks. I do. BHP, Rio Tinto, Vale, Freeport-McMoRan, Newmont Mining, Cleveland Cliffs, Helco, Core. And then you just got your physical gold. Right, they're all down. But the problem is that these stocks are going to keep dropping. They're going to drop. If there's a recession, you don't need copper. You're not going to pay for it. You're going to pay for steel. Steel's going to drop through the floor. Iron ore pellets. Coking coal. You're shutting factories in a recession. You're not boosting copper. So, but I love them. I love these companies. I just feel like if we're heading towards a recession, if you have to make an investment, put a couple bucks into your physical miners. Now look at the crypto. Crypto, excuse my language, shit the bed yesterday. Mara, we have a video on Mara saying it's a sell, but we were saying it was a sell at 22. It's at 16 now. Riot's at 10. Clean energy, CLSK is at 7. I mean, the good news is, right, your crypto miners are still mining crypto, but they're doing it at higher and higher energy prices, and at some point they got to pay the debt back. Because that's what the Mara story is. You got to pay the debt back. And when crypto is ranging from 36 to 40,000, you're still making money. But if crypto falls to 20, 30,000, they're not making money. Personal computers and chips, Apple, Hewlett-Packard, Dell, CDW, and Lenovo are down. See, I like these stocks. I think these stocks are our kids' future, right? Buy a personal computer, buy a cell phone. Not really a cell phone, but Lenovo, you get some exposure. Buy a tablet. Nope. Quantum companies. We'll talk about that later. So this is interesting. So, we're tracking the yields. So 5-year yield is 3.0, 6.5. 10-year yield is 3.10. 30-year yield is 3.18. But the stocks that are platycardic, flat-tailed. Oh, that hurts. I'm sorry. I'll explain. Flat-tailed, high risk, right? They fell a lot. Your leptocardic, low variance stocks are down only just a little bit. And so leptocardic means low risk. It means returns most likely are distributed around the mean. So if you really want to play a funny game, call me, buy a run. I'll give you all the leptocardic stocks, both money-making, money-losing, that have low variance. And it's probably your safest investments. If they pay dividends, they're going to pay dividends. You could double down a little bit. Get some nice dividends. High dividend stocks, my hypothesis, are tending to be leptocardic in this market. I love that. And eventually you can option up. When the market hits the bottom, you option up. Booyah. That's how you make millennial generational wealth, is investing in leptocardic and platycardic stocks. But that's up to you. Chips and semiconductors. Through the floor. I don't understand, right? These are your tech, innovative, future growth stocks, but I guess in a recession, you're out. No chips, no growth. I'm out. Because growth requires money to invest. Chips require massive amounts of investment. And also, if they're talking about raising income tax rates, why would I go out and borrow in a rising interest rate environment to build fabs? Intel, why would you do it? NVIDIA, AMD, Qualcomm. No, Qualcomm's more just the investment side. Broadcom. But let's look at Intel, because we know Intel makes its own chips. So if you're Intel and you've got to invest, I don't know, $50 billion in fabs, why would you do it? Why would you invest a quarter of your net worth in a fab and then have President Biden say you're not paying your fair share? We're going to raise your tax rate from 20% to 28%. Oh, and by the way, it's a friggin' discount because 28% is lower than it's been. Read between the lines. We might raise you to 35%, 38%, from 20 to 40. That's double your corporate tax rate. You get to save, you get to keep half your earnings. Why are you going to spend $10, $20 billion on new fabs? It's not going to happen. So when interest rates go up, companies like Intel, unless we're going to have an industrial policy that supports high capital intensive growth stocks and their investments, you're not going to see these stocks go up. Okay, that was a real mouthful. I got to write all that stuff down. That's kind of crazy. I'm sorry if I'm talking so fast. Specialty retail. Okay? Are you going to go to Wayfair and buy that pillow for $12 plus shipping? Maybe. You're going to go to Etsy and buy a piece of jewelry for $50 if there's a recession? Probably not. Hanes Brands. You know, I took my wife and we bought some undergarments. They were like $40 a piece. A little bit of cloth, some rubber, and some metal. I mean, I know intimate apparel, right, has a lot of cost. But wow, that's why it's down 10%. Because in a recession, Under Armour, PVH, even CarMax, Amazon, Ralph Lauren, Alibaba, Nordstrom's, they're all down like 6, 7, 8%. Okay, fine. Rent-A-Center went up. By the way, Rent-A-Center is more business to business. It's a little bit like Grainger. I still have Minnair for retail, but this is where the investment's against, right? That we're betting against Main Street. We're betting for recession. And so here's what I don't understand. So the futures are down. So the market dropped like 5% yesterday. It recovered in the last minute. It's down again on the futures. What, it didn't fall enough? What, somebody learned something last night that they didn't learn today? Or is it margin calls? Normally margin calls don't happen in the morning, they happen in the afternoon. People might be thinking, you know what, I don't want to go into the weekend holding. I don't want a Black Monday. Now let me tell you where we are, okay? We have 3 stocks right now. We have Corbis. Now, Corbis is probably the riskiest stock in the world. It's at 33, 34 cents a share. They're going to have to reverse split if they don't make it back to $1. It's crap. I know it's crap. It's probably going to 0. But this stock is just as likely to go to $1 as to 0. I'm as likely to triple as to go lose 100%. I'm okay with that. I love what they're doing. They're fighting cancer. American Shared Hospital Services I like, but the after-hours volume of 125 shares does not leave me with a lot of good feeling. There's not a lot of confirmation. Volume was 14,000 shares traded yesterday. But I like this stock because I like the fundamentals of the stock. I'd buy more. If it fell to $2, I'd buy more. I might not mortgage my house, but I might. And then Summit Midstream Limited Partners. Summit Midstream Partners LP. You guys have heard me talk about this for years. I'm long. I like it. Didn't trade much volume, but they had good earnings. They paid $34 million of debt down out of their $1.1 billion. They're ramping up Double E. They got new wells behind their exclusive areas. they're doing fine. So I'm sitting here in 3 stocks. And by the way, I still have some S&P 500. I do. I'm not selling it because I bought it like in 2008. The taxes on that thing would be just crazy. I want to say I'm booking 80% returns on that. So I'm just leaving it. It's fine. So I'm still long S&P 500. I'm long these 3 stocks. So where do I leave you? I leave you with the fact that the market is crazy right now. You have to invest in 6 to 26 stocks to get just a tiny edge. The down stocks, there's meme stocks, they're doing terrible. You're probably down on your individual stocks. If you believe in your individual stocks, hold the course. But if you don't believe, then you're out. I also do not believe that we have confirmation of a reversal. So if you go back to your Dow theory, I do not believe we have confirmation of reversal. I don't. I believe that if you go for a year, you got to have many lower lows. You have 1, 2, 3. So the QQQ, you could argue, has 4 lower lows. You might have confirmation. You might. Now, I think IWM, you do have volume confirmation. You do have it. Low, maybe not. Low, 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 but maybe not. So on the Russell, I'm not sure you have it. You don't have enough lower lows. And on the S&P 500, you get a lower low, lower low, lower low, low. Yeah. So the S&P 500 has reversed its trend, and in terms of higher highs, you have 1 higher high. Maybe. It also could be a Head and Shoulders. So I would say we're starting to see that reversal. You need a couple more days or a couple more weeks of declines to really believe that the market is dropping. And then once the market's dropping, you sell everything. You just stay out of the market once it confirms. But we don't know. I mean, if President Trump was still in the White House, he'd be talking up the markets. He'd have Chair Powell running to print more money and pump more reserves. And the market would go up today and everyone would be happy. We have President Biden in the White House, and he seems to not like rich people. He believes you all are rich people and you should lose your money. He believes that companies are not paying their fair share and it's the company's fault. So if there's a recession, it'll be the company's fault and we should punish them. So I think it's because we have a different guy in the White House that I'm watching for this confirmation. I still don't see it. I'm still not there. We're still in that kind of head and shoulders pattern. So thank you very much for watching. Good luck today on Friday. 2 things. One is, please leave a comment below. Chat away. I'll respond. 2, hit the red subscribe button. Really helps me. And yeah, I haven't been feeling 100% lately physically, but I'm there for you. And I'm here in the market. So you take care now. Good luck today. Bye-bye.